All right, hello, and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. Today's podcast, we have Evan Skorpen on from Lead Edge Capital. Evan is, you're going to hear it. This is a different podcast, but he is a really, really thoughtful investor. He practices more growthy tech investing, very concentrated. As I'll say several times through this podcast, their 13F is public. You can go look. It's 8 to 10 positions, quite concentrated. I just think he's very thoughtful, and we're going to talk through a lot of things. We're going to talk through growth tech investing. The reason he came on the podcast, we were kind of talking about, hey, a lot of software has been crushed by this AI thesis. How does AI how does AI affect tech? How does AI affect software? We're going to talk about, hey, Andrew, you're just a dumb who reads public market filings all day and every now and then hops on a Zoom and talks to himself on a podcast. Evan sits on a public company board. Evan works with a lot of companies. Lead Edge invests in a lot of private companies. How do, somebody with more of an internal view, how does he work with companies to create value? What are some common misperceptions among more like kind of stock jockey types like me on companies, what they're signaling when they put out things, how they're thinking about creating value, all sorts of stuff. So I think you're really going to enjoy it. We're going to get there in 1 second. But first, a word from our sponsors. This podcast is sponsored by AlphaSense. One of the hardest parts of investing is seeing what's shifting before everyone else. For decades, only the largest hedge funds could afford extensive channel research programs to spot inflection points before earnings and stay ahead of consensus. Meanwhile, smaller funds had been forced to cobble together ad hoc channel intelligence or rely on stale reports from sell-side shops. But channel checks are no longer a luxury. They're becoming table stakes for the industry. The challenge has always been scale, speed, and consistency. That's where AlphaSense comes in. AlphaSense is redefining channel research. Instead of static point-in-time research, AlphaSense Channel Checks delivers a continuously refreshed view of demand, pricing, and competitive dynamics, powered by interviews with real operators, suppliers, distributors, and channel partners across the value chain. Thousands of consistent channel conversations every month deliver clean, comparable signals, helping investors spot inflection points weeks before they show up in earnings or consensus estimate. The best part is that these proprietary channel checks integrate directly into AlphaSense's research platform, which is trusted by 75% of the world's top hedge funds with access to over 500 million premium sources. From company filings and broker research to news, trade journals, and more than 240,000 expert call transcripts, that context turns raw signal into conviction. The first to see wins, the rest follow. Check it out for yourself at alphasense.com/YAVP. That's alpha-sense.com/YAVP. All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. With me today, I'm happy to have on for the first time, Evan Skorpen from Lead Edge. Evan, how's it going?
Hey, it's good. How are you? Congrats, by the way, on fatherhood, second fatherhood.
Second fatherhood. You're joining me in the near future in second fatherhood, aren't you?
My wife is due in May 4th. May the 4th be with you.
I like that. I hate to tell you, but welcome to heck, buddy, because the sleep is out the window the moment the second one comes.
Oh, yeah.
Anyway, I'll disclaim having a second one is hard, but another disclaimer, Evan is here. We're going to talk today about more wide-ranging conversation, but we have one portfolio position overlapping. Evan sits on a public board and he files a 13F. We're going to talk about it. So just keep in mind, we might have positions, nothing on this podcast, investing advice, all that sort of stuff. I'll try to disclaim as different names pop up. But Evan, anyway, the reason we're having you on is you and I were shooting emails across and we were just talking about random things, and we wanted to hop on and talk for 60 minutes about random stuff. So let's start here. Your 13F is public for people who don't know Lead Edge. It is 8 positions, though given one of the positions is like a 20 basis point position, we can round it down to 7. So you can practice concentrated growth value investing in names that I've had on the podcast. I think a lot of my listeners are going to be familiar with or interested in. There's Clearwater Analytics, there's Remitly, all sorts of stuff. Before we dive into all the different things we're going to talk about here, I just want to toss it over to you. Do you want to kind of frame Lead Edge and kind of your concentrated style of investments?
Yeah. And thanks for having me, and I appreciate it. Let me spend a moment just to orient the conversation for folks. I joined Lead Edge 8 years ago now, 2018, to build up the public arm. Lead Edge is a known entity as a big established growth equity firm. So invests in growing internet and software businesses, known for investing on the private side. What differentiates us is if you go back to the founding in 2011, Lead Edge spent a huge emphasis on building an LP network of individuals. And so today we have over 750 LPs, more than half the capital at all of Lead Edge kind of parent company comes from individuals. And it's an incredibly powerful network for us where, we're very well connected within the tech ecosystem. We starting in 2018, one of the things we realized is that the venture community views the public markets as a place to get liquidity. And you see you see the venture community send these companies public, and it is hard to be a young public company. I came from ValueX before, where we're kind of known as a long-only activist fund, working kind of behind the scenes with a private equity in the public markets mindset, trying to make chunky investments, concentrated long-only. And they spent their time on large businesses. What we realized is that same toolkit could be brought to the world of kind of young, growing tech businesses. And it's challenging to be one of two, to go public as a $2 or $3 billion company. And so we were able to find, what we're looking for is great companies, great management teams, aligned management teams, but we kind of spend our time looking at companies where there's been some sort of air pocket. Valuation has become dislocated for one reason or another. We'll build a position. Our average hold periods are about 3 years. We own 10 stocks at a time, so kind of think of us as 3 new positions a year. And it's really that. Companies that there's been this air pocket in valuation, we can build a chunky stake, work behind the scenes with the management team to hopefully get the story back on track. So that's us. Hopefully it's a bit of kind of color on who we are.
That's perfect. Let me jump off. I was going to save this for later, but let me jump off here. Air pocket. You mentioned companies that run into an air pocket. And this year, we're recording this at the end of 2025. This year has been a big year for air pockets on anything tech related that is not directly AI or maybe crypto, but really AI, right? If you're not AI, there's the software is dead, all these types of narratives. So I just want to start there, I guess. Like, how do you think about I know as I say this, I realize we said we were going to save this for later, but let's start here. How do you think about the AI is dead narrative for software? And there's been a almost air pocket for 85% of the tech universe, especially the small growthy tech universe. How do you think about investing in that in the AI rapidly evolving world?
Yeah, it's a great place to start. This is a great place to start. I want to start. I think that there's a couple of things you're seeing within. Let's talk about SaaS software to start with. We spend a lot of time in SaaS. It's not all of us, but we're kind of let's target that ecosystem first. If you go back in time, all of these businesses have an evolution from early on. Their growth investments and the decisions to make is really the core decision in a young SaaS business is how hard should I hit the gas pedal on sales and marketing? There's a pretty simple, there's kind of one lever. And the lever is we're trying to build the best products we can, and we have to describe how much gas do we put in the engine. And you then get to a point where, and that is honestly the VC ecosystem. They're typically investing in companies that are at that stage. And it's look, there's a good product. How hard do we have to hit the gas? And it's a debate to be had. Should we be running at money losing? Should we be running at break even profit? We can have that debate. There is an awkward adolescent phase in all SaaS businesses where the business is naturally maturing. Growth has come down. It's no longer a hyper growth, 20, 30% growth business. It's maybe a high teens growth business. But you're at this phase where margins have yet to really ramp to kind of profitability. We could talk about is profitability for cash flow per share or GAAP EPS per share. And there's debates to be had. But either one, you're not there yet on a free cash flow or EPS basis. But you're still early in the growth, margins are ramping. It is really hard to navigate in that moment in time. First off, you're going from, instead of just having one lever to add value, which is how much do we push on sales marketing, you all of a sudden have how much to invest in other things. How do I ramp margins? Do I show a linear margin progress? Do I show kind of a step change margin progress? There's capital allocation. When you're a money-losing private business, you sit on a mound of cash for a rainy day fund. Well, all of a sudden now you're a profitable business. You need to have a capital allocation philosophy. And the idea of having a rainy day fund maybe doesn't make sense if you're now a profitable business. And so you have to totally change your capital allocation philosophy. Often as this is happening, you're going public. So you have employees that are, thinking about that as an exit opportunity. And so you've got turnover in the exec team. It's hard. Let's just start with it is a challenging moment in a lot of businesses evolution. Uh, if you go back to 2020, pre 2021, what you saw a lot is that some businesses had just enough growth that they powered right through this awkward adolescence and they kind of got to maturity just because the growth was so powerful they powered through. You saw lots of businesses actually pre 2021 stumble. And what inevitably happened is that the supply demand environment in take privates was such that there was a lot of people desiring to take companies private, not a lot of public companies for sale. And so any company that was in that awkward adolescent phase, you could kind of wave the white flag and you could sell the business. And it was relatively speaking, not as hard to sell the business at a good valuation. What's happened today, one of the things is I think people are trying to correlate the challenges in SaaS with AI. And I think there certainly is some correlation, but there's a fair amount of it that is just uncorrelated. And what really is happening is that the escape clause to sell to private equity is no longer there, or it's not there there's less of it's harder to get a deal across the finish line. And so you're instead seeing businesses kind of struggle through this awkward adolescent phase in the public markets. And that's just a very different skill set on the management teams. It's a whole different thing. And so I think we often are kind of trying to say what's happening to SaaS is all AI. I think some of it's AI, but some of it's that we're forcing these businesses to grow up in the public markets. And it's challenging on a young founder or a young founding team to kind of navigate that transition to public markets. And I think some of it's just the maturation of their categories. And we're kind of being able to force to do that as a public company.
So one quick thing there. And this might transition us nicely to working with boards and everything. But one CEO that we have in common that we both know, I just remember they said they were doing like a retrospective of the past 5 years, and they said, look, during 2021 in particular, it was growth at all costs. The market was rewarding companies for growing, and we were kind of, the music was playing and we were dancing. We were growing, and we might not have been really looking at, hey, are we growing profitably? Are we spending $1 of marketing costs to get, more than $1 of after-tax free cash flow net present value? Or in some cases, are we spending $2 of marketing costs to get $1 of after-tax? But that's what they're saying. So I want to ask, when you're working with these companies and they're kind of a public market company, how much are they responding to the signals that the market that the stock market, their literal public price is saying, right? If the market's rewarding growth, are they just thinking way more growth? And then when the market pulls back because the Fed increase interest rates, are they all of a sudden thinking, oh, now is the time to cut costs and get cash flow? Or how much are they thinking countercyclically? Because it does strike me that every company has kind of followed the same trend over the past 4 years, right? Interest rates go up, Meta's year of efficiency, everyone's doing year of efficiency. AI, everyone's rushing into AI. So I want to ask you, how much are companies thinking more holistically about the process?
It's a good question. Look, there's no one answer, I think, right? I think every company has a different thing. One of the things that we tend not to buy businesses at huge prices. And one of the reasons we tend not to buy things at huge prices is, double-digit type revenue multiples we tend not to pay. And one of the reasons why is if you're a management team or a board of a company in the public markets trading at 15 times revenue, you have to create a budget for next year. And that budget has to create value for shareholders, right? You can't create a budget that's just destroying value for shareholders. And so inevitably, I think one of the things you saw in 22 and 23 is a lot of companies promising a growth reacceleration in the future, right? They're things are slowing in 23, but don't worry. It's let's use the air pocket word again. It's a growth air pocket, but things are about to get better. And I think sometimes people read into that as the company knows that there's a growth coming in 18 months, just they need to get through this. And sometimes they do. But other times I think it's they're looking at their shares and they're trading at 14 times revenue and Microsoft's at 10 times revenue. And they're look, mathematically, I can't create value for my shareholders unless there is a growth reacceleration. And so, let's start planning for a growth reacceleration. we tend to want to partner with companies. We want to partner with management teams that have options, right? I want options to create value. I want, like myself, and I want to partner with management teams that have options. And if you're just in at a lower starting valuation, in my mind, you have multiple options to create value. You can ideally accelerate growth. That clearly creates the most value. If you're accelerating growth in a profitable way, right? The unit economics work, that adds the most value. But if the world changes and the world changes somewhat, the macro gets worse for your business. If you're in at a lower gross profit multiple, you can ramp margins, you can get to a free cash flow per share story that's pretty compelling that way. All of a sudden, capital allocation becomes a lever. You could buy back shares, that creates value. So one of the reasons we just like lower valuation entry points is because I want to partner with management teams that have a bunch of options. And so when they sit there and look and they're creating a budget for next year, they have an ability to say, I can create value for my shareholders one way or the other. And I'm going to think through what is the macro giving me and how is the best way for me to create value for my shareholders in that macro. That is a luxury that you only have if you're in at a lower entry valuation, right? And it's just harder to do that at higher prices. You mentioned one other thing, and I'm going to mention Remitly here.
Okay.
Because it's been on your podcast before. We have a position in Remitly as well. There is a challenge. Your question was about shareholder. Do companies respond to what their shareholders are kind of saying? And one of the things that I think Remitly earlier this fall got in trouble for was, Matt had a big product day where he's pitching a growth story, about kind of a 10-year vision for how he's going to grow the business. And meanwhile, the stock is trading, precipitously down earlier this year and is now trading at whatever the 10 times EBITDA or 9 times EBITDA currently on forward estimates. And there's a disconnect. One of the things that we've spent some time with Matt on is that when you're trading at 20 times revenue, people want to hear your 10-year growth story because that's what's in their model to create value. When you're trading at 9 times EBITDA, all of a sudden, like your investors, what's the number one variable in their model is not the 10-year growth story. It's what is my free cash flow going to be next year? And I think one of the things that we think Matt is amazing. We love what he's doing at Remitly, but I think there was a disconnect between him kind of telling a story that was like the story you tell if you traded at a 10 times gross profit, but he trades at 2 times gross profit, and the narrative needs to change.
Over the summer, Remitly came out with Remitly for Business. And I think Matt said, hey, this 10X is our TAM. And I was like, that's great. And your stock trades for 9 times EBITDA. I don't think anybody cares about 10Xing the TAM right now.
Yeah, but it's challenging. And look, one of the things that we try to lead with is empathy, which is, Matt has built an incredible business, right? It's close to $1 billion of gross profit. He is focused on a 10-year vision. Just because a bunch of people happen to be trading his stock at a price that I believe is undervalued, why should his narrative change? And I do. So I get that this is a hard challenge that companies to have, and I think I think ahead of the investor day, I think Matt did a really nice job, both kind of meeting his investors where they are. Hey, I get it. You guys are focused on, incremental margins. You're focused on free cash flow conversion. You're focused on what's free cash flow per share going to be in the next 3 years. I also have a base that's like on a 10-year journey, and they've got stock lined up for years. And I want to also recruit the type of shareholders that are not just here for the path to $1 or $2 or $3 in free cash flow. I need to recruit the shareholders that are with me on a 10-year journey. And so I think, I think different companies are better and worse at kind of meeting investors where they are in the journey. And one of the things we kind of always told them is you start from the bottom. What are you trading with for today? Let's check the box that meets the kind of, for your valuation, what are the most important questions? And then we can build from there, but you got to start with a great foundation.
Let me start there. So I did have this on my list. Remitly, again, as you talked about, it's a company I've looked at, very popular on the podcast, so we're hitting it.
Yeah.
They had a investor day last week, pretty well received, right? I think the stock was up 10% in the 2 days following the investor day. you are public filings, right? You are, I went and looked
Yeah.
up on Bloomberg. You're the 20th largest shareholder of Remitly, start excluding some index funds and stuff. And I don't think I'm crazy to say you're basically like the 10th largest shareholder of Remitly. So it's not like you are the axe there, but also you're someone who does a lot of work, works with the companies. Obviously, they're going to listen to you. How do you, when Remitly says we're going to have an investor day, how do you work with them? Do you help craft slides to them? How do you talk to them about, you've already said about, hey, an investor day when you're trading at 9 times EBITDA is different than 9 times revenue, but how are you working with them to craft? Are you working with them at all? What are you talking to them about?
Yeah, good question. Well, look, it starts with, we have a long history with Remitly. We've known, Matt for, I think, well over a decade. We were investors in Wise on the private side going back to 2018. We actually owned Wise again as a public shareholders, kind of starting in 22. So we've kind of known the category for a while. We've also known Matt for a while. And, I think I can't remember if we did a testing the waters meeting with him before we went public, but like we definitely, we were like cheerleaders of Matt for years as as private investors. And that helps because when we came in and when we started building a position in the fall, a year ago, last fall, and so we've been investors here for a little over a year. We've added last fall. We've added since then. So one of the things is I think it takes time to build a relationship, and we very much view it as we're going to be shareholders here for the next 3 years. We want to get to know that, we want to build a long-term relationship. And so early on in it, frankly, it starts with, we need to build credibility with the company that we have aligned interest in. We're not just here for a quarter. And a lot of that starts with, we share our work. We did a customer survey. We send the survey along to the Remitly team. We fly out. We spend a lot of time in person with these companies. We view it as you're building some goodwill with the management team that, I think if you come in guns blazing, let me tell you what to do on your investor day on day one, it's very hard to get people to listen. And so you first need to you need to lay a foundation of goodwill. We love investor days. The reason I love investor days is not because I think it's a great way to get the share price up tomorrow. Like I think actually the actual day itself is often overhyped and a trap for a lot of companies. Like I don't, but we think that the 2 or 3 months leading up to an investor day is a really pivotal moment for many companies where they are setting the strategy upon which they're going to run the business for the next 3 years, right? I think companies can end up having blinders on and live quarter to quarter. And I think an investor day is just like I need we do a year in review every January, and it's helpful for me to widen my aperture. How are things really going? I think companies can use an investor day to kind of widen the aperture and say, am I recruiting the right types of shareholders, the shareholders that I want? Am I telling a story that I think is, have I communicated a multi-year shareholder value creation story that I feel like I can deliver? I think a lot of companies forget all of those things, and they're living in the can I survive another quarter? So we have been spending time with Remitly really over the last 9 months, kind of thinking about, hey, there's probably going to be an investor day here. We have a new CFO. It starts with that. It starts with, are you communicating? Well, first off, do you have a value creation story, a 5-year plan for how you're going to create value for shareholders? And I think that's like a lot of companies are kind of laser focused on, can I beat consensus for next quarter? And they don't have a plan.
Yeah.
So our first question is, what is your plan? What is the variable how do you think about value? How do you think about a successful year? And then our view is, we try not to go in myopically, like here's the lead edge way to do it. We try to meet the company with our first question is, what are the KPIs that you're looking at to determine if you had a good year and if you're on track to create value for shareholders? And I love free cash flow per share. I think it's a great metric. If you want to say my goal is to maximize the free cash flow per share number in 3 years, great, I'm with you. If your goal is, I want to run the best rule of 40 business, great, I'll meet you there, right? I think if you want to tell me we care all about incremental margins, right? And so we're just, I want to deliver more than 30% incremental margins while growing as fast as I can, great, we'll meet you there. Like I I think there's a variety of frameworks that can work. But first is do you have a framework that's important? The second one is, have you communicated that framework to investors? And I think too often in software, I think software in general has one of the most brittle shareholder bases in the public markets, right? Like it's so silly because if you think about software business model, it's one of the best business models in the public markets, right? It's highly recurring. You've got a secular growth trend. These business, I know we're talking about AI, but like this secular growth trend to the cloud, we're still early innings on. And so there's a massive trend of growth in software spend, period, that we're still ignore AI, we can get to it. Like that secular story has not changed. And there's still a lot of on-prem software that needs modernized. The business models are naturally cash efficient. So you generate a lot of cash. They don't consume cash to grow. These are great ROIC businesses. Like software should have the best shareholder bases, right? But instead we see kind of like industrial companies are way better suited at kind of like holding through volatility and all this. Why are we seeing these massive swings? And some of it's that the software ecosystem is so tied up with revenue and revenue beat and raises and like what is consensus numbers and all this. That's like not really true across every sector of the economy. It's really like a small and mid-cap software problem. But I think part of the problem is that companies have not done, I think that there's a whole bunch of people to blame. I think investors are to blame. It's what we reward companies that beat and raise. And so they do, companies naturally focus on it. I think the sell side encourages it. You still today, 4 years after 21, you see way too many companies where the company is putting a multiple, they're ascribing a revenue multiple to it. And I'm like, look, why aren't we, these businesses are quite profitable. Why aren't we ascribing a free cash flow per share multiple to it? So the sell side is encouraging it. But I think companies could do a better job of saying, if I want to recruit shareholders that are here for 5 years, I can't just keep doing this like beat and raise thing. It's not going to work forever. And I need to articulate. And by the way, you can only beat and raise so many times in a row before you have a natural blow up. Like you can never beat and raise for 15 quarters in a row. Just mathematically, it's impossible. Right? Consensus numbers will get too high. And so one of the things we spend a lot of time with companies on is kind of rip the Band-Aid off of that. That's it. All you're doing is kicking the can down the road. And you often see a lot of companies get in this habit of they'll like beat numbers, raise consensus, but then they go on the road for the next 2 months and try to lower expectations so that they can beat the next quarter. And our view is that that's this like 2 steps forward, 2 steps back. You end up not going anywhere. And one of the things we're trying to tell companies to do is like, that's a losing game. And you're recruiting kind of like lower quality shareholders, right?
Yep.
More fickle shareholders. And instead, what you need to do is to say, that's a game that is an unwinnable game. What I want to do is I want to tell a story that recruits great shareholders that are going to be with me along it for the next 3 years. And that's really around like, yeah, tell me how you're going to do it. If it's a free cash flow per share, which is what I think Remitly is doing, I think they've done a nice job kind of laying that foundation.
There was so much there that I wanted to talk about, but
yeah, sorry, I rant a little bit.
No. It was awesome. It's awesome. Just one of the things that I love is, if you're doing beat and raise, if that's what the company is doing, it's very short term, all this sort of stuff. But what I liked about your investor day is they put their heads together for 2 months, and instead of saying, hey, how do we beat next quarter? Like they talk about doing 3 years and something that's actually going to deliver value. But then I'll call a company up and they miss numbers and the stock went down 10%. And I'll be like, what the fudge? I don't know what to tell them, right? Like they'll say, hey, we had 1 customer delay. I can't tell them anything. But if they go and do an investor day and say, hey, here's our 3-year plan. Well, now, not only do you know what the plan is, but now you have something you can hold them to, right? And it's not, oh, we missed revenue by 5 basis points this quarter. But now you can say, hey, you said 3 years from now, your free cash flow per share was going to be $4 per share. We're 18 months into that process. I don't see a path for you to getting to $3 per share. Yeah. What's going on? Do we need to replace someone? Is it but now you've actually got something that you can hold them to that's value creating and not just trading every quarter. I just love that thought of getting them to step aside and like kind of think longer term than just, hey, what is sell side pushing you on? What are the traders putting you on? What are the pod shops who are trying to longer short you against something else putting you on?
It's such a good. So we have an investment in a company called Appian. another software company, and the CEO, Matt Calkins, there owns, let's say, about 50% of the company. And they're in the process of kind of changing their priorities as well. And one of the things that we spent time with Matt on is, I said, the narrative we used is, I have a fiduciary duty to my investors to maximize their returns. And they evaluate me on a quarterly basis or annual basis or whatever. And there's a way that they assess me. And one of the things I told Matt is I was like, I need a way to assess you. And, growth, there's, like Doge hit earlier this year, like there's things that are out of your control, right? They sell to the government. There's a Doge.
Yep.
And I was like, I can't really hold you accountable to just a revenue growth number, because some of that is out of your control, right? Their government shutdown can impact them. There's things that are out of their control. So I said, I need, how can I tell my investors that I'm doing, I'm fulfilling my fiduciary duty if I don't have a way to assess you, my CEO, right? If you think first principles, I have hired him. I am an owner of Appian, and I have hired Matt. How do I assess if he's having a good year or not? And I was like, look, that's, people forget in the public markets, but I am an owner of the business, and Matt works for me. And I need a way to so one of the things we told him is, I was like, look, if you're going to change your philosophy, fine, but you need to have choose a framework upon which you want to be evaluated, set a goal, and then let me hold you accountable to it. And it's interesting. I mean, they've now released their, his goal is a, adjusted rule of 40. And so they have a certain number and they're marching it up. And we can now do a performance review with Matt Calkins every 12 months. Hey, how did the year go? I'm being a little bit facetious, but I think it is important with all of our companies to say, you work, the CEO, we're working together. And just like I have a performance review with my investors, we need to have a performance review. How was your year? And are you fulfilling and the nice thing is, I let them choose their criteria. So, you get to choose the metric upon which you want to be evaluated, but we need to have a metric to determine if the business is making progress.
Evan, you have 8 public company longs, and 2 of them have founder CEOs named Matt. Do you think you have any bias towards the name Matt? You've got a second, get on the way. That might be the favorite in the clubhouse. Okay, let me switch to the part of the conversation I'm most. So I literally just read and come on this podcast and rant every now and then, but I just read all day. People can hear from this podcast so far. You work a lot closer with companies than I think I do. You get a lot more involved with and that's awesome. I think that's spectacular. You sit on the Yext board. I'm long Yext. There's our disclosure there. So you sit on a public board. You work with these companies a lot more deeply. I want to ask some stuff about as somebody who's just trading stocks and reading some misconceptions that I might have about public companies. But let me start here. You mentioned how you let CEOs kind of set the scorecard that you're going to evaluate them on with metrics and everything. As you're getting deeper to know these companies, do you ever come to a company and you're like, oh, I like this business, but the CEO is trying to set me on revenue per share? Let me choose a crazy metric. Trying to set me on revenue per share. And I eventually just have to disqualify them because the CEO just isn't seeing value creation in the metrics the same way I do?
Totally.
Okay.
Look, one of the gating items upon which, what are we looking for when we make an investment? One is it a good business, right? Underlying, is this a business that I would like to own I could own in perpetuity. I could put in my kids' retirement. It's a high quality company, right? Recurring revenue, I can see a path for the company existing for a number of years, right? So we're very focused on business quality first. Second, though, which is a huge gating item, is this a management team that I can work with? And we think about it as in, the world is uncertain. COVID could happen again. Who knows what's going to happen? Is this a CEO and a board, frankly, CEO, CFO, and board, where I believe we think similarly about, if something crazy happened, would we make all the same decisions? And I try to be really mindful about, there's a lot I don't know. There's uncertainty in businesses. Whatever. We can underwrite growth. It cannot happen. It can happen. But is this a team that I kind of trust to make big decisions in moments and times, that I may not have a say in? And we're really that's a gating item for us. We view the world, so we end up kind of self-selecting the kind of teams and boards that we want to work with. That's not to say that we're always right. Sometimes we'll have a disagreement. That, by the way, we don't agree on everything. Like capital allocation is something that we spend a lot of time on. Companies can disagree with, us on it. And
it's not lost on me that
disagreements.
Your roughly three largest positions, Yext, Clearwater, and Remitly, it's not lost on me that all three have active share repurchases going on. And if you looked at like kind of growth of your mid cap tech, I mean, I'm going to tell you that you couldn't pick three random ones and hope to have more than one have. So it's not lost on me. Like, yes, they can assess, but clearly these companies are, at least in my opinion, listening to you a little bit if all of them are doing this.
What matters a lot to me is that companies are thoughtful around a lot of these topics. They're thoughtful around how they structured exec compensation and the inevitable consequences that come with any plan, pros and cons. How they think about stock-based comp dilution and how are they managing their share count, right? And the third, capital allocation. Do they have a thoughtful policy? We can disagree on what is the minimum amount of cash that a company should run with. What's the right amount of leverage? Like it, and as long as companies have a really thoughtful plan that they can articulate and that we can debate, I'm happy to work with you, right? But some companies kind of are like, oh, like I don't, we have an exec comp plan. It rewards, revenue growth, and don't worry about it. And to me, that is harder to work with than I'm okay if you want to reward revenue growth in your plan, but there's consequences to it. And let's have a conversation about what are the externalities, the positive and negative externalities in each plan. So we spend a lot of time on this, but it starts with is it a team that's really thoughtful and thinks these things matter? And not all companies do, and that's fine. They're just not. You mentioned externalities.
As a public company investor, I mean, one thing that I have been hit over and over again with is externalities and incentives. And I want to talk a lot about your insight, but how much have you, like, I'll give you one on externalities. You mentioned revenue growth, which is one of my least favorite things to reward people on, because then all of a sudden you see them investing growth at any cost, bad acquisition. Yeah. But at ROIC, in a software business where ROIC is naturally really high. I mean, I can't remember the exact company, but I've had examples of companies where they get rewarded for higher ROIC. And I'm like, guys, your ROIC is 50% plus. I want you to grow at all costs. I don't care. Just grow. And they're turning down, like 30% IRR projects because it would dilute their ROIC. So that's another example. I mean, they're turning down hugely accretive projects. How have you found when you're on the inside, like those externalities or the incentives play with management teams and everything?
Yeah, so I mean, it's interesting. I mean, Clearwater Analytics, where we have a position, has an exec comp plan that is, their PSUs vest based on revenue growth targets. And you're right. In theory, I would say, like that's a weird, there's no profitability component to it. The reality is that Clearwater Analytics is a business that has a really efficient sales cycle, right? And sales and marketing is relative to comps within software. Sales and marketing is a very low percent of spend. It's a product-driven sales, not our sales and marketing-driven sales cycle. And so we chatted with the board about this, and I probably would tweak the plan if Evan was on the comp committee. I would, but they were really thoughtful around, hey, in any year, what I really want to reward is bookings growth, because the sales and marketing spend is the incremental margins for that business. It's already a very, very profitable business, and sales and marketing is a relatively small and fixed, percent of our OpEx budget. And so we do want the management team hyper-focused on revenue growth, because our view is if this can be a high revenue growth business, the margins will inevitably come. And I think that that's okay for a business like Clearwater that's kind of very much a product-driven sales model. It's probably less okay for a business that's a very sales and marketing-driven, right, sales model. And so these things the reality is it's nuanced. And we're okay with the nuance as long as there's someone. What was important is that they were pretty thoughtful about it. They were like, look, we get that there's a consequence here, but we'll deal with that consequence and we'll make sure that the margins are there. And we understand that the externalities we're creating.
Speaking of nuance, as you know, Paul Mark, I obsess over these filings, right? I read every word. I look for changes in earnings call to earnings call, how people talk about things. I look for, this director is selling stock for the first time in 10 years. This director is buying stock. You've been on the inside, you work with these companies. How much, when I'm looking for every little signal, how much am I picking up random noise versus these things are very intentional?
Look, the answer is both, right? I'm sure that there are times when companies are, doing something and they're very aware of what's happening behind the scenes. The other times is like sometimes sometimes a board member or a CEO is building a ski house or whatever, right? Like I think people sometimes read too much into the exact timings of things. And, we all make kind of random decisions in our lives, right? We're not perfectly rational actors in everything we do. And so, but it is funny. I do think you hold, and remember also, one of the things that we spend time thinking about is the major shareholders in a business, the major private investors in a business when it's gone public. One of the things that I spend time thinking about is what is the return profile they're sitting on? And if you're a venture guy, you've invested in a business, the company's gone public. If you're sitting on a 10x return on your investment, your decisions about when to sell and how to sell are very different than if you're sitting on a 2x return. And it shouldn't be that way. But the reality is anything in private equity land, anything that's above a 3x return is a home run. And so people sometimes are like, look, whether it's a 10x or an 8x, I'm going to go down in history as a home run, and I just need DPI. I need to return cash to my investors. And people forget sometimes that they may not have a view on what's happening in the next quarter, and they may not be calling some nefarious thing happening. It may just be that they're about to raise a new fund and they need DPI. They need to show returns. So there's a million different factors, and sometimes people think that everyone is feeling the share price as much as you are. And one of the things we look for is the people who are buying or selling. What is their overall return profile? And then the second one we look at is what percent of their economic, is it a big position for them? So we talk to companies all the time. We manage a portfolio of 10 names. So you should think about it as roughly each position is 10% of my holdings. And that's a lot. So I live and die every company, right? They all matter to me. But if you're if you have a very small 2% position in something, your decision process around buying, selling can be very different based on the amount you hold.
Dude, it drives me absolutely crazy. I'll talk to companies and, I'll be like, hey, I think this board doesn't own enough stock, or it could use some financial expertise. And they'll be like, oh, we've got that hedge fund guy over there. He owns 3% of the company. We're buttoned up. And I'll be like, no, you have that hedge fund guy over there. This is a 10 basis point position in his company, in his fund. Yes, he owns 3%, but it's because his fund's huge. He sits on your board and he collects $150,000 a year. I know for a fact he is your worst board member because he views this as kind of his bond portfolio and his ability to tell people, I am a public company CEO. He does not care what happens to this company. All he cares is they don't go bankrupt and you maintain him. And it drives me crazy. I don't know about you, but I'm not saying every board needs to consist of, 9 board members with each board member owning 10% of the company or something, because you need diversity of skills and all that. But the worst board members are financial board members who have no economic exposure, or versus their net worth, extremely limited economic exposure. They're the absolute worst. And it's one of the red flags when I look at companies.
Yeah, I think it's a fair look. It is hard to. Everyone wants to be on the board of a large, well-run S&P 500 company. It's hard to build a good board if you're a small public company that's particularly one that's kind of struggling a bit. Or not, not smooth sailing. It's very easy to recruit people to the board of Datadog and the winners, but it's hard if you're a smaller business to recruit a good board. And look, I think the expectations are also really high, where people want to fill their boards with, grizzled veterans who've done it before. And the problem is grizzled veterans who've done it before led big businesses. The reality is they want to, they don't necessarily want to be on board of a small public company that's, struggling in the public markets. And I'm not sure for them, the 150 grand or whatever it is they get paid it's not enough to. So the board. I think U.S. corporate governance overall is fantastic. And I think it's I am a big bull on, I think, capital markets in the United States, I think are fantastic. But I think it is a challenge in the smaller businesses to recruit a great board. And we spend time on it too, which is, what is the quality of the board? Are there a couple people who are really engaged? Is there checks and balances with the CEO? Is there, it's so interesting because in the private markets, your large shareholders, your large kind of venture and growth investors are really like, whether you're on the board or not, they're the CEO's mind trust as he's thinking through big decisions. And we see it, our private, my partners on the private side spend a lot of time talking to their CEOs. Even if we're not on the board, we're a small, shareholder on the private side. We have conversations all the time. What should I do? How should I manage this? And what's interesting is all of a sudden you go public, and many of those investors who are, really kind of like the mentors to the CEO, who's, founder, they all of a sudden kind of put their gates up and say, I no longer want to talk to you because I don't want NPI and I need to get out. It's really lonely. And all of a sudden you're asked to run a public company, deal with quarterly earnings, and you've got all of the people who advised you for the 10 years that you were private now kind of no longer want to talk to you. And, the who wants to talk to you, you have you've all of a sudden kind of cobbled together a board, which can be challenging. And then you have a bunch of hedge fund investors who really just want the shares to go up next quarter. Right. And they're yelling ideas in your head. So I think it's hard to be a small public company. I have a lot of empathy for our CEOs.
Let me step back. So at the beginning of the conversation, you mentioned, hey, a lot of the companies we're investing in are tech companies that have hidden air pocket, right? And I think one of the things a lot of investors find is tech companies that value investing in tech companies is very difficult, right? And I say this in a lot of times you'll have somebody email you and be like, hey, look at this tech company. It trades at 6 times price to earnings. Let's go. I'll be like, yeah, it trades at 6 times price to earnings because they're dying, right? Facebook is taking all of MySpace share. Cool. You can buy MySpace at 6 times trailing earnings. Earnings in the future are 0. You're buying it at infinite. When you're investigating these companies that have hit an air pocket, how are you determining, hey, this is an air pocket versus, hey, as I said, this is value investing tech. This is dangerous. This company, it trades cheap because it is dying and we're buying the proverbial melting ice cube.
Yeah, this is good. I think it's a great topic. I think value investing in tech is challenging for a couple reasons. One is what people think is cheap in tech. There is a long distance between a cheap revenue multiple and a cheap GAAP PE multiple. And one of the challenges that I think you see in tech is that the revenue multiple of a company was high, it's down 50%, now the revenue multiple is lower. That does not necessarily, like, sometimes if you live in revenue multiple land, you'll be like, this is trading at a discount. But it can, you can be still years away from a cheap GAAP PE multiple. And, that chasm of like what is cheap within tech is just, it's kind of wide. And it's much wider than other sectors where everything trades on a kind of like, if you think about more traditional sectors, a lot of businesses trade on a, GAAP PE multiple. And so what's cheap is kind of uniform between companies. So one is I think you can end up kind of calling the bottom on things that are valued way too early within tech because you used to own at a value revenue multiple instead. The second one that I think is hard is we started this conversation by saying tech is one of the best business models and out there, and I think that's true. One of the challenges, though, and the best business model because there's secular growth and great cash flow dynamics. One of the challenges, though, is there's a lot of competition, right? One of the best business models breeds a lot of competition. And so there's, often speaking, there's too many software companies serving the same end markets.
Yep.
So that's challenge one. And challenge two is it's a dynamic space. And if you're not winning, all of a sudden you can be falling behind. And so to your point, you could say, look, something is cheap even on a whatever basis you want to say, free cash flow share, whatever. Is there eternal value? Right. And I think in some other sectors of the economy, there's just less competition and less terminal value risk. And so it's easier to say things are cheap. We we don't think of ourselves as like value investors. We're trying to buy the best, greatest companies. We're buying growth businesses for the most part. And we're buying businesses that have, dominant market share positions in what they do with great, and so we don't think of ourselves as value. We're getting into the value price, but we're trying to buy winners in big markets. We try to find them when there's been some air pocket in the story. And so what do we look for? The challenge is how do you determine what is the business that's secularly at risk and what is the business that's just hit an air pocket, as I use the term? It really comes down to talking with customers. Are they selling something of value to customers that they find a real ROI in? And are they uniquely capable of selling something of value to their customers? If you really think about the core principles, are they uniquely capable of selling something of value to their customers is really what I think it comes down to. And we're pretty myopically focused on if the answer to that is no, either it's not obvious that there's an ROI to their customers for what they're selling, or there's 7 companies all selling the same thing and it's really hard to tell the difference. Those are hard fits for us. And mostly because our view is the perpetuity value can be at risk. So we like I'd say that's the core to avoid those value traps.
We are talking one off the wall question, but we're talking December 17th. Clearwater Analytics, I mentioned public 13F. You can see it, probably the third largest position according to. They are in lots of deal rumors right now, right? I think there was, I can't remember who the first public firm was going to come, and then Tom Bravo came in and lobbed in a bid. There's a lot of deal rumors right now. How do you think about when you're investing in one of these potentially great growth businesses that is hit an air pocket and a private equity firm comes along and lobs in a bid at a premium? And let's just say it gets taken out, and I'm not even going to speculate on a number. And I'm only using Clearwater as an example. I'm not saying you're specifically referring to them, right? How do you think about, hey, it's great, I got a nice premium, I got a nice multiple, versus, hey, the private equity firm sees what I'm doing, they're going to slap some leverage on it, they're going to run the playbook I want, and they're probably going to IPO it at 5x in 3 years. And by the way, you mentioned 3 new ideas a year. That's a new idea that I have to replace. That ain't easy. How do you kind of think about that? Because for me, if I'm, trading the crappy company as an earnest turn into, I'm like, go with God. But for you, just wondering how you think about that process.
Yeah. Look, we spend time with our management teams on this early on in building positions. And one of the things we spend time on is that do we have alignment that no one should aspire to run a Russell 2000 company for the next 10 years? Right? The reality is sitting as a small public company forever is not a great way. That's just not a great way to create value. So if you're a small public company, ideally you have one of two aspirations. One is we're on a path to becoming a big public company.
Yep.
The other one is, hey, we're public today and we're trying to create as much value as we can, but we're probably not, if we're not going to be if we're not going to be in the S&P 500 in the future, then we probably shouldn't be public forever. And that's okay. But my job as Mr. CEO is to figure out how do I create as much value as possible and find the right home for our business. And we're kind of okay working with either camp. As long as I think too often you see companies, CEOs who don't even think about it. And they're just like, I'm just running this business. And the reality is, I think you should be more mindful around, if you're a small public company, there's two paths. I mean, there's a third path, which is just sit in the Russell 2000 for a decade. But I don't want to partner with that path.
That is the best answer I think I've ever heard on that. You said it and it makes it click to me. There's no I love that answer. I absolutely love that answer.
Yeah. And so let's talk about it. So, and by the way, we have companies in our portfolio where I hope that they can stay public forever. And the reason why is the cost of capital. I think they're leaders in huge markets, and I think they could make great S&P 500 companies. And if you're in that bucket that you could be a great S&P 500 company, there's the best ways to create value is either you get an offer from a strategic that's at a price that's crazy, in which case, great, you should take it, right? Or the nice thing is the public markets, the cost of capital in the S&P 500 is around, I don't know what you want to say, 8%. And so the staying public should yield a valuation that is a premium to what my cost of capital is. And so I'm not going to own it forever, but also a premium to what private equity's cost of capital is. And so a lot of our winners over the years, stay public, and they re-rate to prices upon which I can't underwrite a 20, attractive return. And by the way, neither could a private equity fund, because the cost of capital in the S&P 500 is lower, and that's great. If you're not in that camp and you're not going to be S&P 500 for a company, first off, I think some people perceive that as a negative, and I'm like, no. Like, building a great small company, even medium-sized company, right? That's like the lowest smallest company in the public S&P 500 is $20 billion. Building a $10 billion well-run company, that's heroic. But you should think about where's when do you sell the company? I think it should be a strategic conversation around, how do I get the best possible price? Understanding that, a lot of my investors have a higher cost of capital. There's a time value of money. And I think it's nuanced. I think selling a company when you're going through a turmoil, right? You've lost a big customer, you're doing a CEO transition, whatever it is, that's probably not the right time to do it, right? I think selling in uncertain times, I would argue, rarely creates the most value. And vice versa though. But if you've got a great plan, this and like this, I think that running a sale process and finding a home, if you're not going to stay public forever, can create a lot of value. And if there isn't a strategic bid, then the bid is probably from a financial buyer, and again, the answer is it's nuanced. And I'm not answering about Clearwater specifically. I don't know what's going to happen. I mean, look, I think Clearwater has the potential to stay public. Like, I would argue Clearwater is a business that could be a large S&P 500 company. And I think anytime the private markets kind of steals a potential S&P 500 company, it's a bump, because we need great public companies. And I think, some of these could be, but there may be things that I don't know, right? There may be different things in the business that I'm not aware of. And then, I don't have a strong answer, but that's at least thematically how I think about it.
Let me hop somewhere completely different, because we're well over an hour. I've really enjoyed it. Let me ask you, one thing I like to, most of my podcasts are single idea focused, right? And my favorite question is, hey, the market's a competitive place. What are you seeing that the market's missing that makes this a risk-adjusted alpha opportunity? Let me just ask you, because this is something I've actually been introspecting with myself for a lot. You guys, Lead Edge, I'm just going to describe you as growth tech into air pockets, right? Concentrated. Yeah. What do you think Lead Edge is like when you're doing an investment? What do you think your edges that makes your investment or your process or your style a risk-adjusted alpha opportunity?
Yeah. Good question. Look, the edge that we have is we're attached to Lead Edge. And that gives us two very valuable things. One is we have a lot of history with these young public companies, right? And so a lot of public investors, the day they go public, they've only seen, you have to evaluate them based on a couple of quarters of performance. Many times we get to evaluate them based on multiple, many years of performance, sometimes decades of performance. We've evaluated the business over the years. That just helps, right? We have long history of these businesses. And so we can put these air pockets when they occur in a 10-year context instead of in a 1-year context.
Mm-hmm.
And that's the whole. The other one is that you see a lot of investors these days claiming to be constructivist, right? So activist, but constructive, right? It's a popular term. And that is what we say as well. The challenge is that playbook, to be a constructive investor, you need a relationship with the team. You need a relationship with the board, and you need a relationship with the leadership team. And building relationships just takes time. Like, it is a time-intensive thing. And if you're going off alone and trying to, have influence on businesses, it's just the amount of effort you have to put in to start to build those relationships, to get even any, the ear of a team, and to them to listen to you on capital allocation. I think it's a huge effort of time, and I benefit, or we benefit as the lead edge public team from inheriting relationships
Yep.
that, and it's helpful for a variety of ways. So like we were, some of them just are companies we've evaluated when they were private, so you know the CEO that way. Others of them, I'll give what we talked about Clearwater. I'll give you an example. We were interested in Infusion on the public side. So one of the businesses Clearwater bought, we had a small position in Infusion. When Infusion was acquired earlier this year by Clearwater, we'd never spent time with the Clearwater team. And so I didn't know them. But Clearwater's based in Boise. We've got a number of LPs that are based in Boise. And so the moment that deal happened, rather than email investor relations and go through the channel, I emailed our LPs in Boise and I said, hey, do any of you guys know the Clearwater team? They just acquired one of our businesses. We've respected Clearwater from afar, but I don't have a relationship there. And I was like, look, I'd love to come to Boise and spend some time. Can any way you can make a warm introduction? And our view is that, look, we ended up, we didn't even get to Boise, but we did get a warm introduction from an LP to the CFO, and it just enabled an easier conversation. And I think that is a little bit of a head start in building a relationship and having some influence. And so then when we can talk to them about, exact compensation and their structure of it, we're coming in as a friend through an LP rather than just kind of a random investor relations email.
Perfect. Let me come back to one thing we said at the beginning. I just want to make sure, because it's like the headliner, it's probably what I'm going to lead the podcast. I just want to make sure we hit it. We talked about AirPod, but we also talked about AI and software and this huge fear that AI. Okay. I just want to make sure we fully kill the piece. Like, people are scared about AI. And I think for some industries and businesses, rightly so. Like, I think people who think AI is going to replace McKinsey don't really get the point of McKinsey. But there is a lot of software, like a personal example. All my fitness trackers, I unsubscribed and I don't use them anymore. I just toss everything into ChatGPT and use it. Yeah. Now, that's a personal use case, but there's going to be things in software and business that get replaced by it. So how are you thinking about the AI risk? Because it's definitely hit a lot of software stocks. It's created value, it's created air pockets, but there are going to be some terminal zeros from it. So how do you think about the AI risk there or opportunity?
Yeah, it goes back to first. So first off, I don't know the answer. I think that we are early innings in what will be a many decade long story. The impacts will be profound. It goes back to first principles of companies and their relationship with their customers. Let me just talk about Workday as an example. We don't own it. We don't own it, but I'm just going to use it as an example. If you're, I would say, if you're deeply embedded with your customers, you've built a lot of trust over years and years and years, and you've got this really sticky relationship where you're kind of deeply embedded in everything your customers do. The reality is that those relationships just take years to build, and they will take years to dismantle. Now, if you think about what Workday is, ERP, HRIS system, I think of it as kind of two things system. There's a system of record, which is kind of like a database that plugs into a million different things. That system of record database that plugs into different things is not going away. Companies will still need a database and all this. What could change profoundly is the front end way, the user interface upon which we interact with that. And I don't know how that's going to change. Like, we are all I think about it, go back in time when a computer mouse came out, everything user interface fundamentally changed, and it's hard to even envision what it was like before that.
That was my first thought. It's hard to envision using a computer without a mouse.
I don't know the answer, but what I would say is Workday has they don't need to be a first mover here. People are going to come up, there's going to be challengers to HR systems, and they're going to exist. But Workday has such an embedded relationship with their largest customers that no one's going to replace those overnight. And the reality is that Workday has the benefit of these an enormous amount of goodwill and relationships that they can leverage to say, look, we're going to have to update our front end. And the risk would be is that if they don't, people are going to build an AI shell that sits on top of it, right? Which is, if you go back to banking software, right? Core banking software, what Pfizer sells, so sticky, it didn't go away. right? Still today, every bank is run on the same Fiserv software, general ledger systems as they have, were 30 years ago. But they didn't modernize. And so what happened is people built a shell of kind of SaaS user interface, which, a lot of our businesses, we invested a bunch of banking software, sit on top of that shell. That's the risk. So first off, I don't think the risk is that Workday is going to be totally disintermediated. Maybe, but the risk is that you get layered. But I also think, unlike that, the reason Fiserv didn't modernize is, and I'm not picking again on Fiserv, is they're not one piece of software, right? So I think the problem is that what Fiserv is hundreds of different pieces of software that every bank runs on their own custom thing. It will be much easier for Workday to modernize than it would be kind of if you go back to the last transition from kind of on-prem to SaaS, because Workday is already multi-tenant, single instant multi-tenant software for the most part. So it will be a lot easier for them to modernize and to not get layered. But that's the big debate to me is like, there's going to be a new user interface. And are you going to get layered? And then for some businesses, that are kind of like, I'd call the highest echelon of quality, where you're like a system of record that's great, I think odds are very good that these new AI user interfaces are not even going to bother trying to change the core system. In the same way, by the way, that like all of the modern banking software businesses, no one is going after Fiserv. And if you go to ed tech, like there's an SIS system in ed tech. No one is going after modernizing the SIS system. Like the reality is if you're so embedded as a system of record, no one wants to displace you. It's too painful and too slow. And so that's a really nice place to be. And I think you have a bunch of those deeply embedded systems. The question is, there's going to be a new user interface, and are you going to capture it, or is someone going to capture it on top of you? And it comes back to, first off, are you really as sticky as you think you are? And one of the problems that I think a lot of software investors do is they look at gross retention as a definition of are you sticky? And I think that's not the right metric to look at. Gross retention is one metric, but what really determines stickiness is is like, I talk about Oracle level sticky, where what's sticky to me is when you've raised prices every year and your customers hate you and no one still leaves today. That's sticky. If you've gotten to rate really good gross retention, but the way you've gotten there is by offering a really low price and kind of offering excellent customer service, well, you could be ripped out, right? So it goes to kind of unit economics of like, structurally, how sticky are you? And then if the answer is you're structurally sticky, I think you've got a couple years to try to build that AI user interface layer on top. And I think that can be a real opportunity for a lot of businesses if they pull it off. I think it's going to be profound in many areas, but you got to win it. So
if I can just, you were at ValueX. I think the other interesting thing is the SaaS, the on-prem to SaaS switch, and everybody switching to SaaS and subscriptions. That was hard, right? Investors didn't know how to model that. Companies had to look forward, and they had to take a hit, and they probably needed a big shareholder in their shareholder list who was supportive and saying, hey, go take this pain because it's going to result in a better long-term business, right? With the AI risk, all the stocks are screaming, right? They're down. All the investors are saying, what's your AI strategy? So yes, you might lose an AI, but one thing I kind of take comfort from is there's not a single public company CEO in software or something I know of who's just like, AI is not a risk, right? Like they're all at least aware. Their investors are asking, they're thinking about it. If they say, hey, we need to increase tech spend by 2% of revenue this year to accelerate our AI switch, like none of their stocks are going to take a hit from that. So I'm kind of a little bit, relieved just by it's so obvious and the pain's so there that they can make the switch. Whereas in 2015, if you came out and said, hey, this software we sell for $500 a seat, we're going to switch it to $30 per year. I mean, stocks were tanking, right? Even though a lot of them were saying, hey, this is a much better business in the long term.
I totally with you. By the way, also the gross margin profile of that new user interface may be very different. Mm-hmm. But again, I think that investors know that if you added a new revenue, if Workday added a new revenue stream, which was, AI agents that was additive to the core system of record, and it came in at I think people would be thrilled. and would be happy to understand. We already understand professional services are lower. I'm not worried about that. I think we can manage through that. I think part of the problem, though, is everyone is expected to show progress on AI immediately. And I think for a lot of these big enterprise software systems, we're still early days on kind of like the actual build out of AI products. But you're expected to show progress on a quarterly basis. And I think the reality is that for a lot of these segments of the economy, we're just not there yet. And so you're seeing the challenge that I think companies are facing is that they're being forced to either say, we're not there yet, there's nothing on AI quite yet in our sector, but that's not a very satisfying answer for investors. Or you have to kind of like play up this AI thing when it's a little bit of emperor has no clothes. There's nothing, it's not quite there in the numbers yet. And both of those are really challenging, right? You're kind of like, it's a lose-lose. That'll get better as we start to, first of all, that'll just work through it. And I think it will be real. And I think there will be opportunities. And I think you'll start to see it. But we're in that little early phase where investors are really anxious to see progress. And it's not, at the enterprise level, I think progress, we're still early on in the days of having progress.
Evan, I can keep going, but we're starting to run up on the time stop. I just want to take a second. Anything else? I mean, I think we did a really wide-ranging, hit a bunch of different stuff. Anything else we should be talking about or takeaways you want the audience to have?
No, this is fun. Appreciate the time.
I appreciate you hopping on. We're going to have to do it again. I've got Nick, your analyst, who put us in touch. I've got a lot of respect for him. Every time I've looked at a growth tech company, if I had listened to his words of wisdom and the risk factors he identified, I'd be a much richer man. So I've got a lot of respect for him. But I appreciate you coming on. We're going to have to do this again in the near future, and we'll just kind of go from there.
Awesome. Thanks so much. Hope you have a great holiday.
A quick disclaimer, nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.